All right, let's jump right in. We are about to pull back the curtain on the massive, fast-paced world of Forex trading. So, whether you're starting from scratch or just trying to figure out what all the buzz is about, think of this as your personal crash course. And hey, for this little explainer, our source material has a great name for it. We're officially enrolling you in the School of Pipsology.
Yep, that's what it's called. But I promise you, this is going to be way more interesting than high school economics.
So, the real question is, are you ready to wrap your head around the basics of the biggest financial market on the entire planet? I thought so. Let's do this. Okay, so here's our game plan, our syllabus, if you will. We're going to cover what Forex trading even is, then get into how traders actually try to make money. After that, we'll learn some of the lingo, pips, lots, and leverage, and we'll end with, honestly, the most important lesson of all, how to protect yourself first. So let's start with Chapter 1. What is Forex trading? Because before you can understand how to trade, you really need to grasp the unbelievable, mind-boggling scale of this thing. So, in simple terms, Forex, or FX for short, is just the global marketplace where national currencies get exchanged. Now, unlike, say, the New York Stock Exchange, it's not a physical building. Nope. It's a gigantic decentralized electronic network that connects banks and institutions all over the globe. And that makes it, by a long shot, the largest financial market in the world. And look, when I say largest, it's kind of hard to even picture the scale. So think about the New York Stock Exchange. They trade about $25 billion a day. Sounds like a lot, right? Well, the Forex market, it trades around $2 trillion every single day. It's not just a little bigger, it's a whole other galaxy of financial activity. But what are you actually trading? Well, the source material gives us a perfect way to think about it. When you buy a currency, let's say the Japanese yen, you're basically buying a tiny share in Japan's entire economy. If you think Japan's economy is doing well and is going to get stronger, the value of the yen should go up. The price you see is really a reflection of the world's confidence in that country's economic health. So which currencies are the big players in this global game? Well, it's no surprise. The US dollar is the undisputed king. It's on one side of almost 90% of all Forex trades. After that, you've got the other heavy hitters, like the euro and the Japanese yen. That's why you'll see so many currency pairs quoted against the US dollar. Okay, so we know this market is enormous, but the million-dollar question, or maybe the $2 trillion question, is how do traders actually make money from it? Let's get into the mechanics. So every single trade involves a currency pair. The first one you see listed, like the euro in EUR/USD, that's called the base currency. Just think of it as the thing you're actually buying or selling. The second currency is the quote currency, and that's simply what you're using to measure the value of the first one. And that brings us to the two fundamental moves you can make. If you go long, you're buying the pair. You're betting that the base currency is going to get stronger compared to the quote currency. And if you go short, you're selling the pair, betting that the base currency is about to get weaker. It's all about trying to predict which way that relationship is going to move. You might be wondering, well, how do the brokers make their money? It's through something called the bid/ask spread. See, for any currency pair, there are always two prices at any given moment. There's the bid price, which is what you can sell for, and a slightly higher ask price, which is what you have to buy for. That tiny little gap in between, that's the broker's fee, and it's your basic cost just to enter a trade. And here's exactly what that looks like on a trading screen. For the British pound versus the US dollar, you can see the two different numbers. You'd sell to the broker at that lower bid price, or you'd buy from them at the higher ask price. And that little space between them, that's the spread. All right, moving on. It's time to learn some of the language of Forex. We're going to break down 3 words you absolutely have to know to be in the game: pips, lots, and leverage. This is the trader's toolkit. First up, the pip. It stands for percentage in point, and it's just the tiniest move a currency's price can make. Usually, it's that fourth number after the decimal point. So if a currency pair moves from, say, 1.1050 to 1.1051, that's a 1 pip move. All your profits and losses, they're measured in pip. Next, you've got the lot. This one's easy. It's just the size of your trade. Now, a standard lot is 100,000 units of a currency, which is huge. But don't worry, brokers offer much smaller, mini, and micro lots, which lets people who are just starting out trade with a lot less money. And finally, we have the most powerful and most dangerous tool of all, leverage. This is what lets you control a big pile of money using only a small amount of your own. For instance, with 50 to 1 leverage, you could control a $50,000 position with only $1,000 in your account. The broker basically loans you the rest.
But, and I cannot stress this enough, leverage is a double-edged sword. It is, without a doubt, the single biggest reason new traders fail.
Because here's the deal. Just as fast as leverage can blow up your profits, it can blow up your losses with exactly the same power. A tiny price move against you can completely wipe out your account in seconds. Yes, it's powerful, but man, is it dangerous.
And that leads us perfectly into what is by far the most critical part of this whole explainer. We need to have a reality check about the risks before you ever think about putting real money on the line.
Okay, let's just be brutally honest here, because the source material is the vast majority of new traders, something like 90%, lose money. This is not a get-rich-quick scheme. Trading is a really hard skill, and it takes a long time to learn. And you should only ever trade with money you are 100% okay with losing. So, this brings us to the single most important piece of advice you will ever hear about trading. You absolutely must practice on a demo account, that's with fake money, for at least 2 months, minimum, before you even think about going live with real cash. Seriously, this isn't a friendly suggestion. It's a non-negotiable rule for survival. You know what? The source wants us to really make this stick, so let's just do it. Put your hand on your heart. Say it out loud. I will demo trade for at least 2 months. Okay, now touch your head and say, I am a smart and patient Forex trader. I know it feels a little silly, but the lesson behind it is deadly serious. So there you have it. You've got the basics down, from the sheer size of the market to how a trade actually works. But way more importantly, you've got the warning. Success in this world isn't really about being the smartest or the fastest. It's about being the most disciplined and the most patient. Which leaves just one question, really. Are you patient enough to be in that 10%?